Good morning. Welcome to the morning market briefing. Today is Friday, March 20th, 2026. I hope you are doing well. We've got a lot to talk about today. But first, I want to just quick reminder about the Jacobs Ladder Group. We've been talking about them a lot, but something we feel pretty strongly about. So again, we're having a lunch and learn on April 1st here in the office. But if it's something that you'd like to learn more about, which I'd certainly encourage you to do, please go to the website or check out the YouTube video and podcast that Tom and I did with the founder, Amy Odell. With that, Tom, let's talk about what I did yesterday afternoon. So I'll fill you in, and we've talked a little bit about it so far, but I haven't given you all the details yet. So I went down to the CFA, which is the Chartered Financial Analyst Group here in Atlanta. Really large society, actually. They have a monthly investment strategy roundtable, if they do, and there were only about 8 or 9 people there yesterday night. But I did find it pretty interesting how people are thinking. So first of all, AI is real, and it's disintermediating a lot of things. And I got to speak a little bit softer now because I talked to one private equity person. And so the private equity person, obviously a big portion of their costs are accounting fees and legal fees. And what he was telling me, their legal fees are down 70%. All that due diligence, all that paperwork, all that refinement, they basically have an AI do it all, and all the lawyer does is just sign off on it. So you're taking all those billable hours, they're like 10 billable hours down to that are really done by a paralegal, down to 20 minutes. And then it's same with the accounting fees down 30% because you're able to do it so much faster. So I do think that's real, and it'll be interesting if there are any roll-ups, like private equity roll-ups of these service businesses, these accounting or legal service businesses. It'll be interesting to see what happens. We do not own a position in Intuit, which owns TurboTax, as well as what's the
Quicken. QuickBooks.
QuickBooks, yes.
Yeah.
But
same thing though, right? And Quicken, like the home version.
Maybe yes, I think so.
Yeah.
So it owns those, but it trades at 20 times earnings. I think that's expensive given what we're seeing today. And then LegalZoom has been just kind of getting smashed for a while, but it's still worth $1 billion. I would be surprised if
For
that's
now.
here like in 5 years. So,
Unless they just implement that and fire all the attorneys that they
yeah,
pay on a contract basis.
right. So it'll be interesting to see how that evolves. The second piece was I was telling you a little bit about him earlier. This is kind of like this kind of mad scientist, and I hope he wouldn't take offense for me saying that, but this guy is he's like a character out of Pirates of the Caribbean. He last year made so much money trading gold that he quit his job and became a full-time trader just for his own account.
Oh wow.
So he's really interesting. He has a lot of skin in the game, and he thinks just dramatically differently, and it's really interesting to hear what his thoughts. And his view, and I would agree with this, is that Hormuz must be opened this weekend. He's like, maybe first couple of days next week, but it's got to open, because if it doesn't, you're going to have wells shut in. You're going to have, and when you cap a well, like that's a big deal. You're capping massive production. And the reason you have to cap a well is because there's no place to put the oil. Like all the barrels are full over there. Like they cannot get it out of the region. And so you can't just have oil just squirting into the sky. So you have to cap the wells, and that would really, really damage oil and put things in a very nasty place. Not just for the U.S., but if the U.S. is getting hurt by high oil, think about the rest of the world that doesn't produce its own oil, that consumes more as a percentage of. We're a very wealthy nation. Food and energy are a much smaller portion of your consumer budget, my consumer budget, the average American's consumer budget than everyone else in the world. Everyone else in the world is going to get smashed by this. And if we cap the oil, like that's not coming back online. So it has to get open this weekend. And this person, Patrick's view is that it will, because simply it has to be done. And we've seen Europe now getting on board. We've seen China starting to get on board. The rest of the countries out there are getting on board with this. He said that if it doesn't, you're going to make 1929 look like child's play. So if that scares you, he has a flip side. He says, if we do open this and are successful in this, you're going to have the biggest economic boom of our lifetime. You're going to have $40 a barrel oil as far as the eye can see. All that oil that's just shut up there is just going to just start flowing to the whole world. You got the Venezuelan oil that's coming online. You've got, the world is going to be flooded with cheap energy that fuels a manufacturing and production boom, the likes of which we've never seen before. And he said that his view is that this would just put the U.S. dominance on a world stage, cement that for another 250 years.
Man, we need that scenario. My follow question is...
He says that deficits would be gone basically for the U.S. because we're not... Our costs would be so low. We basically issued in stable coin to the rest of the world, which are like Chuck E. Cheese tokens for us, but really valuable for them. He painted a picture that was just marvelous.
Man, need that. My question is, does anyone have eyes on Greta Thunberg? Because if anybody's ready to have expensive oil and to rain on everybody's parade, she's probably riding a mine with a little motor as fast as she can to the Strait of Hormuz, because nobody hates cheap oil and productivity like Greta.
That's
and
true.
People forget middle name Tintin. That's a real thing.
I do forget that.
Her middle name is Tintin. So that's my only thought is, if somebody's got to get her, let's see if we can get her, busy for the next couple weeks. I don't disagree. We got to get this thing open. It's the most important piece of global macro that there is. And that's the tough part about, in this scenario, the question is, what do you do with your positions in oil? Because Exxon and Valero, these have all done really well. If oil prices skyrocket, they will continue to do well. And they might be the only thing that does do well. But if the positive scenario comes out, you want to be selling here. You either you simultaneously want to be overweight and underweight oil. And that's tough. So the question is, do you just take that and put that in cash and see what happens? I'm not quite sure what to do with oil at this point.
I think the weight of the world is on Hormuz right now, and I think that's meaningful. UK, France, Germany are all on board now after having not been on board. China, I think, is on board. The Saudis are on board. Israel, obviously, the U.S.
Futures are down now, but I texted you because you're on your way to that CFA thing yesterday afternoon, and at 3:10 or so, there was the news that all the European countries were in agreement they needed to get the Strait open. Then you had Netanyahu saying, this war might not actually last much longer, and the market went from down huge to slightly positive for about 20 minutes, and then ultimately closed down just a little bit. So the market is ready to rocket on the resolution of this conflict. The question is, how do we resolve it? How do we get out of this thing?
Yep. We did get a piece of news yesterday that kind of got lost in all of the Iran news, and that's bank deregulation. This is something that's been talked about for a while. The previous guy, Michael Barr, was just absolutely terrible. I remember listening to that open. I've talked about this before. Last year, they had an open meeting, and the guy didn't even show up. It's literally a bank supervision meeting. His staff showed up. They presented all the arguments of why there should be some more moderation in the regulation. He was just like, no, I'm not going to show up. And it was really a bad look. Michelle Bowman took over that job. Michael Barr's just kind of exited stage left. He's just like, oh, it's not my thing anymore. But the key elements are going to be less strident capital rules made by people who have never been in banking before. And so this actually better aligns capital rules with actual risks versus kind of just raising capital regulations arbitrarily. And the implication is that there'll be a 4.8% reduction in capital requirements for big banks, about a 5.2% reduction in required capital for your regional banks, your Regions Financial, and then for smaller banks, kind of like your Kraft Bank, who was on our call on our macro show last October, that could be up to 8%. So this is a really good news for the banks. It should increase lending, which is really important at a time where private credit has a lot of question marks. So this could really grease the wheels of the economy further.
I think in the same way that Besson is in the right seat, I think Mickey Bowman is in the correct seat now to be leading this charge. I did see an interview with Scott Besson yesterday afternoon where he was basically blaming the blow up in private credit on the fact that we've made it so impossible for banks to lend money. And so people are trying to get economic deals done, get money flowing through the system. And so private credit became a huge market very quickly because it's all literally, they call it shadow banking. It's like, because you don't have a bank involved, you're just lending money, willy-nilly, clearly. But the importance of having a bank is the bank has to underwrite the deal. The bank has to make sure there's appropriate collateral. They have to look at the deal and assign an appropriate return for the amount of risk you're taking in order for that to be a feasible deal for the bank. But if you just make banks have to sit on enormous amounts of money, they can't lend money out, they're tied up in every different way, then people go elsewhere, and then you cease to have the regulation, which is what we're seeing now. Is just you're out in the Wild West, and there's no sheriff.
The other thing is, think about a bank versus a private credit fund. People complain about banks having no skin in the game, and management teams having no skin in the game in 2008. But look at banks compared to a private credit fund. Banks actually have to own the loan. They're required of collecting payment on that loan, versus a private credit fund is just a broker. They collect money from investors and they allocate those funds to people who need capital. And the private credit fund just takes a cut.
Yeah, you really don't have any fiduciary responsibility.
It's like if there was a real estate agent who had who didn't really need a relationship, and just all they needed to do was sell homes, or a used car salesman who just needs to move metal, doesn't care about where it's going, doesn't care about where it's coming from, just needs to move the metal. That's what a private credit fund is.
It's an annuity. I've complained a million times about annuities, but when people are like, "Oh, get in this annuity, you can make 5% a year for the rest of your life," but what you're doing is there's a salesman who presents themselves as a financial advisor. He sells you an annuity. He clips a 10% commission. But the deal is between you and the insurance company. And if that's a bad deal, it doesn't matter to him. He got his 10%. He's got no responsibility to you. And then if you want to get your money out, well, there's surrender charges. The first year, they're going to clip you 10% to come out of it. Well, why is that? It's, well, they paid that guy 10% to get you into the deal, and he doesn't owe you squat. And that's what private credit is. It's like, oh, Joe Schmo needs money. I take the money from Ben. I take 2% charge. And I give the money to that guy. And then what's my responsibility? There isn't one. My responsibility is to continue to cash checks on how much money you invested. And so that's the insidious part about this. But at least a bank that would be their balance sheet. They lent the money, and that's going to increase their net interest income, which is above and beyond what they pay you. And guess what? If they make more money, they can pay you more on your deposits, and then they can get more deposits, and they can be a viable bank. But they put all these different, straps down. It's basically they're tied to the floor, and that's what do you have to do in that situation? Well, it's like, we have to keep all these capital requirements, so we just have to buy treasuries. And they buy and buy and buy treasuries. And what did that do? It ultimately led to banks going under because you were getting no return on treasuries. And that's why Silicon Valley Bank. So all these regulations that were put in place to make sure that banks don't fail actually did the opposite. And it also created an externality, which is the private credit market, which is now blowing up as well. So it's like you've got to be able to facilitate the gears of the economy, and banks are there to do that. But if you make it impossible for them to do that, someone else is going to do it, and there's going to be absolutely no oversight. And so that's what we're seeing now. And it could, I mean, the private credit thing is just absolutely collapsing around everybody. And thankfully, we were smart enough to know that that was a bad deal. We don't own any of that stuff. And so I feel great about that. I mean, go back 6 months, 8 months, a year, we were saying private credit was a very unpopular place in our mind to put your money, and now it's collapsing. So
FedEx reported earnings last night. FedEx had a good numbers to report. They actually upgraded guidance for the year. The volume was pretty solid across the board, probably mostly in the international side. We have a chart on that, Hicks. I know. But the freight side was a little bit weak. So the freight is related to the LTL business, which is the less than truckload business. That continues to be under pressure. It was down about mid-single digits in the quarter and continues to do so. On the yield side, which is how much they get paid for each package that's shipped, we're seeing some positive movement there. Again, especially on the international side, seeing some good numbers on a year-over-year basis there. On the LTL, on the freight side, what FedEx is doing, so they're spinning this business off beginning on June 1st. So they have some costs associated with that, and they're really trying to make sure that they go for yield and profitability in that business. What we're seeing is that although trucking demand is very strong, what a lot of manufacturing customers are doing is that they're opting not to go the LTL route. They're just putting it on regular trucks right now. But the thesis there is that LTL is going to benefit there. That's the second order effect. That's according to people over at FreightWaves. So I do think LTL is going to come through. That's kind of the next leg in this logistics trucking recovery story. So keeping an eye on that one. In terms of my market thoughts overall, I do think the economy is still actually pretty good. We had a really solid Philadelphia Fed number, very strong New York Fed number earlier this week. Inflation, it wasn't as concerning in those reports. And importantly, the market is very oversold. The bear sentiment is the highest since Liberation Day. 52% of institutional investors are bearish right now. 1.25x put to call ratio, basically the highest since September 2023. The fear and greed index over at CNN is signaling extreme fear, 16 on a score of 0 to 100. And actually, I looked through the methodology, and as much as CNN can chase headlines sometimes, this one actually makes some sense. And then Goldman, you probably saw this tweet, Tom, but they said long-only funds sold almost $10 billion across our floor today and ran a 50% sell skew. This is the largest day of net selling in our data set's history going back to 2022 and a 5 sigma event. So if you think back to your normal distribution curve,
it's like 1 in a trillion.
Assuming this is parametric, yeah, it does not happen. A 5 sigma event does not happen in a parametric distribution. So extreme oversold levels.
5 sigma is 1 in 3.5 million.
Yeah. So every 3.5 million days, you'll have a day like yesterday.
Yeah. So once so far, period.
So I do think that we're at pretty oversold levels. We have massive options expiration representing about 10% of the stock market today, which is absolutely wild. So I don't expect really a big move. What happens on big options expirations is you tend to just pin a certain number. But I do think that there'll be some opportunities today. I think that we'll know a lot more on Monday as we talked about. So on a news basis, next week is not that busy. I'll actually be up in New York on Thursday for Sunbelt's Investor Day, now that they're traded on the New York Stock Exchange. But Tom, as you're thinking about, as we go through today and into the weekend and early next week, what will you be paying attention to, and where do you think things will ultimately shake out?
Man, the last part of that question, I don't know. I feel pretty optimistic. The more you see on TV that this is going to be a never-ending war, that it actually is not going to be. I mean, think of all the things that have been aggressively pushed.
30% decline in GDP in 2020.
Yeah, all these different things. The tariffs were going to cause empty shelves. People don't know anything, and people who aren't actively involved in what's going on know even less. So I'm going to be obviously keeping my eye on anything that comes out of Scott Bessent, because I am pretty certain he knows what's going on and has a firm grasp of what the economic realities are. And I'll probably base my assumptions on that. But I mean, really, the game plan is going to continue to be looking at allocations. We're starting to get to the point where, since bonds have outperformed stocks, we're a little heavy on bonds. We have a lot that are rolling off and looking to be opportunistic and buying equities. And we were opportunistic yesterday. I had a couple accounts there underweight for equities. You buy when the market is down 1.5%, and by the end of the day, it's only down 0.2. That's a net win over the market. And we might be down again today, but we've still got quite a buffer from where we were buying yesterday. And if you look at the performance of the different tenors on the Treasury yield, we've talked a lot about buying the long bond. The long bond is flat for the year. The 2-year Treasury, talk about 5 sigma events, is up 50 basis points in the last week. I mean, that's a massive move for what's supposed to be one of the least interest rate sensitive places. I mean, if you look at month over month basis, the places on the bond market that have gotten crushed, 2-year, 5-year, 7-year, 10-year, what hasn't underperformed? 20-year and 30-year. So all this worry that inflation fears are going to send the long end spiraling, well, that doesn't work in a steep yield curve. What we're seeing is an unsteepening, a flattening of the curve. And so what you're seeing is, as the rate cut expectations move out, well, that means that the 2-year is going to reflect where people think the federal funds rate is going to be, and we're cruising towards 4% there, which I think is very oversold, but you're not getting punished by owning long bonds, which is what people thought was going to happen. What actually happened is you're getting punished by owning 2-year Treasuries, which we've been saying are not cheap for a long time. And now, hey, listen, if we got bonds rolling off, buying a little 2-year, locking it at 4%-ish for 2 years, that's nice on a AAA security. We can avoid some of the credit spread widening that's kind of a knock-on effect of private credit by buying very clean stuff that's short now, which we couldn't do before. And so now, there's a lot of nuance to what's moving, but what's surprising is people think, bonds are getting crushed. And when bonds get crushed, the long end's going to get hurt the most. That's actually not true. And it's very counterintuitive, but that's what steepness on a yield curve provides you, that people are confused by. And I'm sure everyone is sleeping now or has turned off the podcast. But the bond market is dark and mysterious. And you've got to be on it or you're going to get popped. And I think this is a very good example of that.
It's exciting. And it's exciting because there's opportunity. And I'm excited to get back to the desk and start, again, continuing to edit and revise portfolios accordingly. So we're here. If you have any questions, let us know. Otherwise, we're going to be at it today, and then hope you guys have a great weekend, and we'll see you on Monday. Thanks. Bye.